Good morning, everyone. Delighted to be hosting this next session. My name is Eric Corrett from MarketEye. Delighted to have another Eric Lookoff, with us here this morning, our time. I think it's late his time, joining us from Houston. Eric's the CEO of QuickFee Limited, ticker code QFE. Eric, thank you for joining us today.
Oh, thanks, Eric. Good to see you always. Thanks for having me.
Pleasure. So, there might be a mixture of people on here that know the QuickFee story and those that may not. So let's just start with an introductory question, Eric. So maybe just at a very high level, give us the 5-minute spiel on who QuickFee is, what you do, what markets you're playing in.
Yeah, QuickFee, we're a loan originator and payment merchant acquirer. And I really kind of start to tell this story in sort of 3 stages. QuickFee 1.0 was founded in 2009 in Sydney, essentially with a single loan product, which was merchant-backed. It meant essentially quite low risk. And the goal was accelerating cash flow, reducing back office costs, improving customer loyalty. That was the core of the business in sort of stage 1.0. And payments wasn't a core component of that stage. QuickFee 2.0 came to the US in 2016. That really started there. We had some early mover advantages. And key to that was being able to leverage partnerships and certain third parties and able to help QuickFee launch quickly and grow quickly in the US market. At the same time, you have the core vertical that we service in professional services at the very early stages of a digital transformation. And I'll sort of talk to that a little bit more as that has accelerated certainly because of COVID. Payments is the focus in the U.S. Certainly, lending is a nice business for us, it's a growing business for us. But payments is the long-term sort of jewel in the crown here. And 2.0 QuickFee really starting to leverage more payment activity, ACH, bank transfers, credit card processing, as well as the newer product that we've launched, which is really a blend of payments and lending, which is our buy now, pay later solution. And 1 in 3 of the top 400 accounting firms in the United States trust QuickFee as their payment service provider. And that's really important. It's a trust we take very seriously. And ultimately, what's come out of 2.0 is a very high-performing merchant portfolio. And if you think about how you'd ultimately really value the growth in the business in sort of the US 2.0 version of QuickFee, you have a merchant portfolio that has high organic growth, it has a high yield, very low attrition, and almost no merchant risk whatsoever, because it's a merchant-backed lending solution, and we manage the top 400, the largest firms in the country. So very, very low risk. And that increases the value of that portfolio. QuickFee 3.0 is really what we're emerging to. It's coming out of the COVID period. We've launched Cube, which is our proprietary payments platform. And that allows QuickFee to become much more self-reliant, moving more independent of our partners, those early partnerships, those early third-party providers, and that means more yield. As you take on a greater self-reliance in your underwriting and your risk management and your compliance, you have and you see greater yields on your processing volume. We're beginning to see that now as we move into this 3.0 stage. And that's true of banking, cards, lending, buy now, pay later. You'll hear us talk more and use words like payment facilitator and sponsor bank. And it really means that we're able to do more of the transaction processing and load ourselves. And that means we're able to retain more of that yield as we do so. It increases our revenue, increases that enterprise value of that portfolio that I mentioned before, gives us greater control of service delivery and also our customer experience. And that's really sort of where QuickFee has evolved to.
Great intro, Eric. Thank you. So just elaborating a little bit more on the 3.0. So what does that mean? Can you give a bit more examples of what does that mean for your services and your products that you're providing to customers, and maybe how that has changed or how it's growing on the 1.0 and 2.0?
Yeah, I'll give you an example. So in credit card volume as an example, when you're in a 2.0 stage where U.S. credit card volume is meaningful, there's money to be made in that. And card processing volume, bank transfer volume in the 1.0 AU, there's not as much sort of margin there, there's not as much risk, not as much revenue opportunity. In 2.0, we've had for example, referral partnerships. So our yield on a card processing dollar of volume might be anywhere from 18 to 20 basis points. As we move more towards being a full registered payment facilitator, part of our 3.0 version, that 18, 20 basis point yield increases to 50, 60 basis points, which is where we're moving into that type of yield now. And as a full registered payment facilitator, you would see yields move into the 90 basis point range, where you're really just sitting slightly above the interchange costs of the actual card networks themselves, because you're doing more of that heavy lift independently.
Got it. So, talking about the two key segments of the QuickFee business, you have professional services and you have buy now, pay later. Maybe again, just to help sort of build the understanding of the QuickFee business model, can you talk through those two segments, how they work, and what it is that you're doing in each of those segments?
Yeah, professional services is our core segment. It's the overwhelming majority of our volume, of our revenue, and profit. It's essentially the mid-level to enterprise accounting and law vertical in both the U.S. and the AU regions, and our value proposition to that merchant base is essentially helping them accelerate their work to cash cycle, get paid faster, and make getting paid much more convenient, much more secure, plenty of options for your customer base. So it improves that customer loyalty along the way. Our buy now, pay later solution, new that we launched really at the very end of 2020. We've rebuilt a number of things with that product solution over the course of 2021, tailoring it into the correct market. And that's growing very nicely now in terms of where we were even 3 months ago with that solution. It leverages both our payments and lending technologies. And so our BNPL solution, the way that we've tailored it for our core strategy, sits very well as complementary to our overall solutions. In that product, we're leveraging the existing credit limit that a cardholder has. So we're securing the full payment up front, which means there's no late payment, there's no late payment fees. And also it means it's a very low credit risk solution. And that allows us to not have to do a consumer credit check. And that means a faster speed at the point of purchase. Our BNPL volume is sitting right around 20% of total lending now, and growing at a faster rate than our core lending in the US.
Got it. So just talking a little bit more about the buy now, pay later, it's obviously still fairly nascent, and it's obviously growing quickly, but still quite a small part of QuickFee's business. Maybe it's obviously quite a competitive space, buy now, pay later, particularly when we think about it in Australia. So maybe can you just talk a little bit more about how QuickFee fits into that landscape, and perhaps what's different about QuickFee's buy now, pay later offering?
Yeah, the interesting thing about buy now, pay later is I think it tends to get painted with a broad brush that there is a landscape. There isn't a landscape. There's many landscapes. There is not a one size fits all buy now, pay later company or buy now, pay later solution. So there's not a single landscape. I speak on buy now, pay later panels in the US, all over the country. I'm on panels with banks and networks and other buy now, pay later solutions, processors, acquirers, and everyone, the only thing they have in common is that they're enabling additional time to pay. Outside of that, they have different go-to-market strategies, different mechanics, different risk profiles, different monetization strategies. There really isn't a solution that is homogenous, right? And so you have some that are focused on solving the terminal side of buy now, pay later, and that experience. You have some that are focused very narrowly on consumers, some that are on merchants, some that are on ISOs, some that are on banks. So there really isn't a single one. Our solution, QuickFee's buy now, pay later solution, we tailored it to fit our broader strategy. We offer a low risk option for merchants to accelerate their invoice collection. We do that with our core professional services. And when we look at our market for buy now, pay later, it's not that indifferent from our core vertical. You don't see as much sort of enterprise size of merchant, but you still see that service-based merchant that is sending an invoice or they're being paid after a job. We focus in the service sector. We're not interested in retail, online e-commerce. We like the higher transaction tickets. Again, our credit risk is secured, so the higher ticket helps us improve our yields there. And we don't issue consumer credit, so we don't have those late payments or challenges and losses that come along with that. I tend to think of it this way. Our goal is to help merchants make their necessary services more affordable. We don't have any interest in helping consumers, spread a bar tab or a pizza. It's just, that's not a vertical or a space that we have an interest in.
Got it. You talked about really low credit losses, which I think is obviously a very attractive part of QuickFee's business. That kind of leads me to the next question. There's a lot of, it's a hot topic now around regulation in the buy now, pay later space. What is your view on what's happening there and how it might change the broader landscape? And again, any impacts to the way QuickFee operates?
I think regulation in the BNPL space is a positive thing. Absolutely. Anything that helps consumers better understand the payment options that they're accepting, and particularly one that has additional sort of lag effect of payments and keeping up with that. If in our case, we're securing that up front, and so it's more of a recurring payment type of credit card product more so than a lending solution. But I think anything that allows the consumers to better understand what they're buying, how it works, impacts to credit if there are any, and also allows them to build up positive credit and take advantage of the benefits of making those payments on time. I think those are good things. The U.S. space with the consumer, the CFPB, that group is really taking a sharp lens on BNPL providers in the U.S. I think it's a positive thing, and you will see good regulation that comes out of it. In U.S. fintechs typically run ahead of regulation whenever you see new products come out, and there's generally a lag effect where the consumers' interests and advocates come in a little bit later. They tend to lag the innovation. And we're seeing that here with BNPL. None of it is surprising.
Got it. Thank you. Just a reminder to the audience, if you would like to ask a question, to please use the text box on the right-hand side of your screen. Moving along, you briefly mentioned your new processing platform, Cube, Eric. Maybe if you could just talk a little bit more about what that means for QuickFee. And then I guess linking it back to consumers and perhaps the consumer experience or merchant experience, what, if any, changes will they notice through the new platform?
Cube is really what's enabling this 3.0 stage of QuickFee, right? That allows us to be much more self-reliant in terms of how we acquire merchant transaction volume, how we process it, how we settle it, and how we monetize it. We couldn't do what we're doing now with the yield increases, for example, in our credit card volume, if not for the Cube platform. So that was really important. It's quite a bit of work that really began with the announcement of the launch of the BNPL solution at the end of 2020 and really carried through all of 2021. We've launched it here at the beginning of this year. We've completed the migration of our ACH volume and card merchant volume off of our proprietary our prior legacy platform. We'd anticipated being there towards the end of May. We're actually finished it towards the beginning of April. The other is it gives us more control over service delivery and how we tailor that customer experience and the merchant experience in terms of how they manage their payment activity. And again, we have more control over that, and that allows us to, I think, create a greater payment optionality for consumers. It's really what consumers want. They want lots of payment options. They want them to be fast. They want them to be secure and simple. That's really it. It's not magic in that respect. One of the great things that our Cube platform does allow us to do is, for the first time, we're able to combine our buy now, pay later solution with our core professional services vertical. So we have this very large and fast organic growing professional services space that, for purely technological reasons, we couldn't offer our credit card buy now, pay later alongside our pay in full credit card option. We can now do that, right? And so that's actually launching here within Q4. So we're very excited about that. So quite a bit of it is just really about control and what that means to us in terms of creating more optionality.
Got it. Thanks, Eric. One of the unique aspects of QuickFee, the fact that you're operating in Australia and the US, I guess maybe can you talk a little bit about why those two markets are the focus, and perhaps maybe looking down the track, do new geographies interest you? Does the technology that you've got and platforms that you've got work in other geographies as well?
Yeah, obviously we're in Australia because it's where we were founded, where we began, where we're traded. The U.S. market, sizable. I think the niche that we are staking out, both in terms of our core professional services portfolio and where we're going with buy now, pay later, has tremendous greenfield ahead. So we don't really look at moving out of region in terms of where we could be 2 years from now, 3 years from now. This 3.0 stage that I mentioned, this PayFac journey, that's a roughly 2-year process. Because in order to not just transact the merchant payment volume more independently, you also have to settle it to your merchants, and that means moving funds back through the banking system, which requires quite a bit of banking oversight. And in order for banks to provide that level of sponsorship and oversight, you have to have a certain amount of volume that makes it materially valuable for them to provide it. Right. And so this next sort of 2 to 3 year stage is really about continuing to grow and create that volume that allows us to raise our, increase our yields and accelerate our profitability. So that's really where the focus is the next 2 to 3 years.
Got it. There are a bunch of questions coming in, Eric. One's around cash burn, another around getting to cash flow break even. So I'll bring them both together. Obviously, there's been a large investment in tech and employees. So what's going forward, what does that look like for QuickFee, and in terms of timing to get to cash flow break even? Is there something that you can, some guidance or parameters you can provide around that?
Yeah, the launch of Cube was an important milestone for us because it allowed us to really change the level of OpEx and product technology investment. Because there's really not a reason for us to spend the next 18 months building what we've spent the last 18 months building. So now that is out, we've been able to scale back the product and technology and OpEx spend in certain areas of the business. And so, for example, our fiscal year 23 would see roughly a $4 million AUD reduction in OpEx off of our FY22. And that, combined with the increased yields both for our ACH volume, we had a number of merchants early, sort of during that 2.0 stage, that had some fixed pricing. So volume would go up, it would decouple from revenue growth for a certain group of merchants. we shifted those to percentage billing at the beginning of this year. So we'll see both increasing yield for our ACH volume combined with increasing yield for our card volume. When you add that on top of the organic growth rates, you then layer out the OpEx reductions. We're anticipating run rate profitability at the end of FY23 or slightly earlier. And with adequate cash headroom, that conceivably we really wouldn't need to do a capital raise at all. I think where we may have an interest in doing something might be where it could accelerate that payback journey, because then essentially the yield increase is worth what you may need in the capital side to go acquire the volume to reach those levels I mentioned before on the bank sponsorship side. So at this point, it's really all about volume. We've got the yield solved, we've got the growth solved, we've got the OpEx solved, we've got the platform solved, and we're sitting good on cash outlook as well.
Great. And so maybe an extension to that, Eric, in terms of getting to that point of break even and the funding that you have to help fuel the lending and the growth in the business, you're comfortable with that level of funding and access to funding?
Definitely comfortable with the access to funding. We closed on our Northleaf Capital facility really at the very beginning of this year in January, early January. We took our first draw on that. That's a USD $40 million facility with an accordion to $70 million. We have roughly a $5 million revolver that comes along with that. It's multi-currency, so it supports both the AU business and the US business, and we think the rates on that are attractive. Really, it's about creating that additional volume that leverages the lines. But we're fine on lending volume. We have quite a bit of sufficiency there.
Great. Just another question's come through about Cube. Does a Cube open up potentially more integration opportunities and capabilities for QuickFee with merchants and then also with other payment partner integrations as well?
It absolutely does, right? Absolutely. And so one of the new solutions that we've launched, our Connect solution, which is intelligent invoicing, there's quite a bit of sophistication around that. That has been integrated now into one of the larger practice management solutions in the US, a system called ProSystem FX from Wolters Kluwer, which is a large practice management solution provider. And so we're able to integrate with Cube into a solution like that. The other integrations we can do with Cube now, it really allows us to have broader integrations both on the authorization side of the transaction, as well as the processing and settlement side of the transaction. So it allows us to be a bit sort of processor agnostic, authorization agnostic, allows us to add additional vendors in where necessary, gives us greater negotiating sort of position from a yield standpoint as well. But the integrations are great there. We can do much more white labeling of our back office processing solution as well. We're really more about the volume than necessarily about the brand. And because as a payments business, it's really all about the volume.
Got it. Good time for maybe two last questions, Eric. It'd be remiss of me to not ask about COVID and how you saw that impacting the business. Did you see an accelerated shift to online payments, and were there any other impacts in the business?
Yeah, we saw a really interesting effects of COVID, right? COVID is really the catalyst which has taken QuickFee from 2.0 to 3.0, right? From this version of sort of being heavily dependent on third parties and not really monetizing the most of your yield on the volume that you have, not necessarily sort of owning your merchant. And what happened with COVID is you saw this flush of stimulus in both the US and the Australian markets that had a bit of a temporary slowness of the lending business. But particularly in the US, you saw consumers shifting from lending to payments. And so our payment volume really exploded. The second effect of COVID was that it caused our merchants who are sort of at this early stage of digital transformation I mentioned, very paper-based invoicing heavy vertical. It forced them really to shift to more electronic invoicing. And so you had electronic invoicing shift along with a shift from lending to payments happening on top of each other. And then the last is really sort of our go-to-market. In that vertical, it's very seasonal. The enterprise accounting space in the U.S., you've got sort of two primary, main tax seasons, right? The middle of April, the middle of October. And so that vertical kind of shuts down in those first 3 months of the calendar year, first almost 4 months of the calendar year and towards the end. So there's a condensed window where you can go to conferences and see your customers, work on your organic growth, add additional merchants into your portfolio, which we do. And so you can't do those conferences if you can't travel. COVID now coming to an end, it's opening up domestic travel. You're seeing more of those events scheduled at the same time.
Great. Maybe one last one, Eric. Thank you very much for your time. Just around the next 6 to 12 months and even beyond that, obviously you've got Cube rolled out now. You're growing the buy now, pay later part of the business. You're able to go out to these conferences and market the company. What are the key things that we should be looking out for over this next 12 months or so?
These next 12 months is all about execution, right? And now that we've sort of arrived at this place where we have stability, we have to execute on the growth side and make sure that our organic growth holds up. Make sure that we're continuing to make the most out of this opportunity to add additional merchants into the portfolio. Execute on what remaining work we have on the PayFac journey. Right. We're also going to be launching some additional very exciting new products. We've got recurring payments that are launching in the next quarter. We have as I mentioned, our buy now, pay later solution combining in with this large, fast growing professional services space, also launching in this quarter, as well as some other integrations that are pretty exciting in the automotive services space, in the home services space. But for our buy now, pay later solution. So we're really interested to see how we execute over these next 12 months, but we have a lot of confidence and we're feeling pretty good. Great.
All right, Eric, our time is up. Thank you so much again for making the time and joining us at your late hour. And if anyone has any further questions that weren't covered off, please feel free to reach out to Eric or myself. Our contact details are on the materials lodged on the ASX. So thank you very much, Eric.
Great, thanks. Good to see you, Eric. Take care.
Thank you. Next up is Adore Beauty.